What was the last question we did this time? Question number 10. Okay. So question number 11. Did we do question number? Oh, okay. I think there's some numbering issue. Yes, write down question number 11. Coefficient of variation. It's a March 2003 question. A company is expecting projects X and project Y with the following information. Then we have expected NPVs, we have standard deviation. Which project will you best recommend based on the above data? Yes, how should we decide? Yes, sir. How do we calculate coefficient of variation? Mean divided by standard deviation, or standard deviation divided by mean? चेक करो. Yes, how do we calculate CV, coefficient of variation? We've made list of these formulas multiple times. We calculate by saying standard deviation divided by mean. Okay, so calculate coefficient of variation in each of the cases. This is 90,000 here. So say the projects can be ranked. Question number 11, solution. The projects can be ranked based on coefficient of variation measure. Based on coefficient of variation measure, comma, which can be calculated as, standard deviation divided by mean. Okay. So then again, you can make a similar format. You can make a table where you would say first say standard deviation, then say mean, then say coefficient of variation. This is project X, this is project Y. Here you can say expected NPV, which is the mean. Then how much? 1,22,000, 2,25,000, 90,000, 1,20,000. Call this as A, call this as B. This would be C, which is calculated as A divided by B. So 90 divided by 122 and 120 divided by 225. Up to 2 decimals should be sufficient. Yes. How much is the first one? 90 by 122? 0.74. And how about the second one? 5.3. So which one is better? Yes. Lower the better. So write down below that. Since coefficient of variation of project Y is lower, that is risk taken per unit of return is lower. That is, risk taken per unit of return is lower, comma, project Y should be given preference over X. Project Y should be given preference over X. Are we good? Please remember, don't do it the other way around. It is always standard deviation divided by mean. Interpretation is risk taken per unit of return. Are we good to move on? Alright, then question number 12. Given below is the information of the shares of return and data from two companies A and B. Year 2002, market return 12%, 11 and 9%. Company A 13, 11.5, 9.5, 8, 11, 10.5 and 9.5. Determine beta coefficients of company A and company B. Yes. How do you calculate beta coefficient of a particular stock? बोलो जल्दी जल्दी. हाँ कैसे निकालते बीटा? How do we calculate beta? Come on, it's not so difficult. हाँ. Yes, covariance divided by variance. Covariance of two variables together and variance of whom? In the denominator? Variance of the market. So if you have this data, can you calculate covariance and variance? I'll make the format for you. So just write down the first sentence. The beta coefficients of shares A and B can be calculated using following formula. Say covariance is equal to covariance in bracket A oblique M. Covariance in bracket A oblique M divided by variance in bracket M. Covariance between A and M divided by variance of bracket M. Okay, so I'm making this table. You can solve it exactly in the same fashion. Two 2002, 3 and 4. Wait for me to finish. Okay, return on market, to which we are going to call as M. Then company A, to which we'll simply call capital A. And company B, to which we are going to call B. Okay, let's plot the data. 12, 11 and 9. Then data A, 13, 11.5, 9.8. 11, 10.5, 9.5. Once you've done this, now see, this is where you have to imagine. We need, what does the formula say? Covariance is calculated as, how do we calculate covariance? Bolo, how do we calculate covariance? N, x minus x bar, y minus y bar by n. So we are going to need two covariance, one between m and a, which will help us calculate beta between m and a, one between m and b. So what are we going to need? We are going to need m minus m bar, a minus a bar, b minus b bar. Then using this data we can calculate covariance. What we are also going to need is m minus m bar square, which will help us calculate variance of the market, isn't it? So the first column that we will make here, we will say this is m minus m bar. Okay, wait for me to make all the columns. Then you can say m minus m bar square. Then this is where you can say a minus a bar. And this is where you can have b minus b bar. Okay, so this should be sufficient. And then start calculating numbers here. Is it done? Any question or doubt? Please ask questions if you have any. How did we get covariance? Covariance is calculated as summation of x minus x bar, y minus y bar divided by n. So this is where we calculated m minus m bar, a minus a bar. This is the total here in this column. So it is simply this 4.83 divided by 3. X minus x bar, y minus y bar divided by 3. And this is calculated as 2.33 divided by 3. Are you done writing? How did I get variance? Summation of m minus m bar square 4.67 divided by 3. Yes, any question, any doubt? Anuja, Neha, are we done? Kulbhushan हो गया? Okay then, so next question. So see, basically these kind of questions, extremely easy to calculate. You should know the flow, that what do you do first, what do you do second, and remember the formulas, should not be difficult. Question number 13 now. An investor is seeking the price to pay for a security whose standard deviation is 3%. The correlation coefficient of the security with the market is 0.80. Market standard deviation is 2.20%. The return from the government security is 5.20 and the market portfolio is 9.80. The investor knows that by calculating the required return, he can determine the price to pay for the security. What is the required return for the security? Can you solve for this? What is the required return for the security? How do we calculate required return? Using CAPM. What is the formula for CAPM? RM नहीं. RF, yes, RF plus perfect into beta. Risk-free rate of return plus market risk premium into beta. Market risk premium is calculated how? RM minus RF, return on market minus risk-free security. Now, Have they given us return on market here? Given 9.0. Have they given return on government security? Yes, which is a risk-free rate of return. So what do we need apart from this? We need beta. Do we have data to calculate beta? We have correlation coefficient, then we have standard deviation of the market, and we have standard deviation of the stock. Is that data sufficient to calculate beta? Check your formula list, the one that we made on the previous session. For beta we had two formulas. Yes, what is the other formula for beta? Yes, so which standard deviation will come in denominator? See, the second formula I never remember it. Okay, see, everything is perfectly neatly integrated with logic. Think of it this way. Start with correlation. Do you remember the problem with covariance? What was the problem with covariance? When we studied covariance, I said it has got a problem. The problem is that for large number, covariance turns out to be unnecessarily large. Isn't it? A higher covariance does not show a very strong relationship. For example, if my data set has got higher absolute values, covariance would also be higher. So we need to standardize covariance. How do we standardize covariance? So when my data values are higher, covariance will be higher, standard deviation will also be higher. So I divide a higher covariance with higher standard deviation, isn't it? And then that standardized number is called correlation. So correlation is equal to covariance divided by standard deviation of first stock into standard deviation of second stock. So that's how we got correlation. Then what was the formula for beta we learned? We learned that beta is between covariance of A by B divided by variance. So let me call this as M. Let me call this as M. Let me also call this as M. This is variance of M. Now, if I can shift these term here, so it becomes correlation into standard deviation A into standard deviation M is equal to covariance. So here, correlation between security A and M into standard deviation of A into standard deviation of M divided by variance of M, which is nothing but standard deviation multiplied twice. So standard deviation M, we can eliminate these two M. And then what does it give us? It gives us correlation into standard deviation of security A divided by standard deviation of market. So this is the formula we need to use. Are we clear here? So write down below this that beta for the risky security can be calculated using following formula. Beta for the risky security can be calculated using following formula. So say beta, and then you can say in smaller letter of A, beta of A is equal to correlation in bracket A oblique market in bracket A comma market, correlation A comma market multiplied with standard deviation of A divided by standard deviation of M. So karo 0.8 into 3 divided by 2.2. 0.8 into 3 divided by 2.2. 1.0000. So it's coming. So it's coming out to be 1, is it? Then 0.090. Okay, whatever is the beta. Fair enough. So that's your beta value. Then write down below that expected return on the security can be calculated using capital asset pricing model. Okay, and then write down the formula for capital asset pricing model. Expected return or required return on a security is equal to risk-free rate of return plus return on market minus risk-free return multiplied with beta of the stock. So the risk-free rate of return is given to us as 5.20. So this is 5.20 plus this would be 9.80 minus 5.20 multiplied with whatever beta you had. Give me the final answer. Yes, what is the answer? How much? Huh? 10.214%. So 10.24%. Do you have the same answer? Kulbhushan, Niranjan? Is it the same? Anuja, is it okay? Are we good to move? Question number 14. Required return on the security. So let's start. An investor is seeking to the price to pay for a security whose standard deviation is 2%. Wow. Correlation is 0.8. Market standard deviation is 2.2. Government security 5.2. This is 9.89. What changes? I think instead of 3 and 2.2, the only variable that is changed is this has been made 2. Okay, great. So will you be able to solve this? So 14 is your home assignment. Then question number 15. Calculate the expected return of the security and interpret the same from the following information. Beta, expected return on market, risk-free rate of return. If another security has expected rate of return of 18%, what would be its beta? The second part is interesting. क्या number होगा इस question का? 15, right? Yes, this should be 15. So solve the first part of the beta. First part of the question. Find out expected return of the security. Simply use CAPM model. What is the answer to the first one? 5. 10.5. It's simply plug and play. Just put the formula, get the answer. Done? Are all of you getting 10.5? What will be the answer for the second one? Yes, try to get this orally. Don't solve for it, but tell me orally or just do rough calculation and tell me how should we solve this. What should be the approach, Angelica? So we have to reverse calculate beta. So say 18% is equal to formula. And then whatever you get would be the answer. But logically, see how you can do this orally is. It should be 3 by 9, 1 by 3, yes, 1.33, correct. See, what is the intuition here? The intuition is that what would be beta of market? What is always beta of market? Beta of market is 1. It's always 1, right? So how much for 1 unit of return, market is giving extra return of how much? Market is giving extra return of 9%. So if you take risk of 1, you get extra return of 9. So if you saw in the earlier question, the risk was 0.5. Therefore extra return should be 4.5. And therefore the answer was 10.5. Are you following this? So here, how much extra return do you want? Extra return that you want is 12. कैसे 12? रिस्क फ्री रेट 6% है, आपके स्टॉक पे 18%, so extra return is of 12. For extra return of 9, you take risk of 1. So for extra return of 12, the risk should be how much? So proportionate calculation, and that will give you 1.33. Following the logic? So, but yes, that's not how you want to solve this. You can solve this by simply putting this into equation. So write down that the beta of the second security can be calculated using capital asset pricing model. Beta of the second security can be calculated using capital asset pricing model. And then after having written the formula, then say 18% is equal to 15% plus 15 minus 6% multiplied with 6%. 6% plus 15 minus 6% into beta. So this will become 12. 12 plus 15 minus 6, 9 into 12 is equal to 9 beta, and then that would make beta is equal to 1.33. Are we good to move on? Question number 16. CAPM evaluation of security, expected rate of return, March 97 question. The beta coefficient of Target Limited is 1.40. The company has been maintaining 8% rate of growth in the dividend and earnings. The last dividend paid was rupees 4 per share. Return on government security is 10%, return on market portfolio is 15%. The current market price of Target Limited is 36. What will be the equilibrium price per share of Target Limited? Would you advise purchasing the share? Okay. So to solve this, we need some additional information now. See, understand this part logically here. First, understand the concept of perpetuity. Let's say if I tell you that there is an investment which you can buy for 500 rupees and which will always give you a return of 10% forever. How much will you get every year? 50, correct? Now, if I tell you that there is an investment which will always give you 100, okay, this is the cash flow. The rate of return for that investment is 10%. What is the value of that investment? 1000. How did you calculate 1000? You said 1000 is equal to 100 divided by 10%, and which means that value of a perpetuity investment, okay, value of a perpetuity is equal to cash flow divided by discount rate. So whatever is the cash flow to which we divide the discount rate. So here you can write down, okay, not as a part of the question but explanation, it will take us some time. So say value of a perpetual investment, is equal to cash flow divided by discount rate. Okay, so below that, write down one example. Say example 1. If an investment offers a return of rupees 30 per annum, if an investment offers a return of rupees 30 per annum till perpetuity, comma, appropriate discount rate is 12%. Appropriate discount rate is 12%. The value of investment can be calculated as cash flow divided by discount rate, so is equal to 30 divided by 12%, which would be how much? 250. So 250 is your answer. Okay. Now in finance, generally perpetuities are not very common, okay, in real world scenario. Why in India are we allowed to issue irredeemable debentures? No, isn't it? They have to be redeemable. So meaning of which is that there would always be restriction, okay, as long as we are on the fixed income side. But what is more common in finance is growing perpetuity. Okay, so this concept that we're doing now is extremely important. Understand this. See, this is where, let me see if it's a completed model. We've built a model on Hindustan Unilever. Okay, so the purpose of this model is that we want to value a company. We want to value Hindustan Unilever here. So what we've done is we've hard-coded data for 2009, 10, 11. That means we've just captured this data from the annual report. And then we've forecasted data for subsequent years. So 2014, 15, 16, 17, 18. So in my model here, I've forecasted data for 5 years. Can I forecast data for 2019 as well? Or no? My question is that the fact that I have forecasted data for 2018. What is the end purpose? End purpose is we want to value the stock. Okay, so I'll show you my valuation. My valuation sheet shows the value of stock today as 317, whereas the market price of the stock is about 600. So why did I forecast the data only till 2018? Because after that the business will shut down? No? Then? Are you following what I'm trying to say? That why should I focus only till 18? Why not till 20, 25, 30, 35? Yes, there are limitations, isn't it? You cannot predict for 6 years, 7 years. But does it mean that after 2018 business will not work anymore? No, in accounting we have a basic fundamental accounting assumption which we call this as going concern, isn't it? So now there are practical limitations. We cannot really easily forecast data for 2019, 20, 25. So what we generally do is that we assume, so I'll show you in my assumption, I have assumed a terminal growth rate of 5%. Okay, what does it mean? See here, what I've calculated is free cash flow to equity. Okay, so in the next reading, you would be getting some understanding of this. I think you must have studied this in your accounts somewhere. Free cash flow to equity. नहीं पढ़ा नहीं पढ़ा ठीक है. So basically what is the intuition here? See, when I am valuing a equity share, okay, there is some number, we call this as FCFE, but let's not get into technicality. What it means is how much is the cash flow which is left for an equity shareholder after taking care of all the commitments, after taking care of capital investment commitments, bondholder commitments. So free cash flow. Okay, and then what is the logic? Value of any share is present value of future cash flow. So let's say that for 2000 we started predicting for HUL from 14, 15, 16, 17 and 18. These are my 5 financials. Okay, so how much cash flow? Let's say I get a cash flow of 100 here, then I got 120, then 140, then 150 and then I got 170. Okay, so I have individually modeled them. So how did I get these cash flows? I individually predicted how the sales will behave. Okay, so if you'd see in my model here, there are specific assumptions I have with vis-a-vis income statement. Okay, so these are my assumptions, that how will my income will behave, how will my expense will behave, specific assumptions vis-a-vis balance sheet, working capital assumptions, number of days. So we predicted that data based on solid assumptions, based on understanding of the annual report, based on management discussion and analysis. But then I know that business will keep on growing till perpetuity after 2008. But then I do not know that what would be an exact cash flow. So what we assume is, we assume a terminal growth rate. Okay, so in model I have assumed this to be 5%. What does it mean? It means that if this is 170, in 2019 I am assuming that my cash flow would be 170 plus 5%. 178, okay. And in 2020 I am assuming this to be 178 plus 5%, which means 187, which means I'm assuming this to be a growing perpetuity. It is still a perpetuity now. Why? Because it's going to come forever. But then it's not a constant perpetuity, it's a growing perpetuity. So it kind of creates a mathematical loop. Okay, it will keep on growing. So you can solve for this. Now I'm not going to do the math behind this, but how I can solve this, I'll just show an example. So what we use is this formula. Okay. To find out the present value at time 0, so we say value at time 0, use the cash flow of time 1. Okay, then you are going to divide it at what rate? What is your discount rate? So we'll typically call this as cost of equity. And then what is the rate at which the cash flows are growing? And then we will say minus G. Okay, so how does it work? Let us say my cash flow at time 0, okay, my cash flow at time 0 is 100. I have assumed that my cash flow will grow till perpetuity at 5%. And let us assume my discount rate is 10%. Okay, so which means, let's say we will take 2 cash flows. Cash flows 1, in fact let's take 3. Cash flow 1 is going to be 100. So 100 into 1 plus 5%, 105. Next cash flow would be 105 plus 5%, and then next cash flow is again 115.726, and then again it would keep on growing every year at the rate of 5%. Right, so if I want to find out present value, it's going to be really difficult, because how many years I'll keep on doing it. So we use this formula. What formula? Value at time 0 is equal to cash flow of time 1 divided by cost of equity or discount rate of 10% minus growth rate of 5%. So denominator would be 5%. So 5%, the value of the stock is coming out to be 2100. So what it has done is, it has taken present value of all the future cash flow that I will have till perpetuity. Okay, if you want to cross check this, if this is the logic, that value of stock at time 0 is coming out to be 2100, then how much would be the value of stock at time 1? For example, I decide not to value it at time 0. Okay, so I decide that I want to value the stock at time, let's say 1. So value of stock at time 1 would be cash flow of time. Value of stock at time 1 would be cash flow of time 2. So this number divided by 5%, and now the value comes out to be slightly different. But then I want to know the value at time 0. Okay, so how do I do this? that I will take a total of cash flow at time 1, 2310, and then I will discount it backwards for 1 year at the rate of 1%. Value would be at the rate of 10%, value will be same again. Instead of taking value at time 1, if I take value at time 2, okay, again the same logic. Then I take total of these two cash flows, year 1 and year 2. And if I discount both the cash flows backwards at the rate of 10%, and if I take a total of these, again the value would be exactly same. So which means that this formula, no matter what, how many years the cash flows are, it is always going to take present value and give you that sum here. Are we clear? And in equity valuation term, this formula is called as, anyone? We call this formula as Gordon growth formula. Okay, so what is the Gordon growth formula? Value of stock at time 0 is equal to cash flow of time 1. And that's the most important trick here. So when you want to value a stock at time 0, you always have to use the subsequent cash flow divided by KE minus G. K is equal to cost of equity and G is equal to growth rate. And this growth rate has to be perpetual. Okay, so you can say Gordon growth formula, in bracket also say growing perpetuity. Okay, so let's do an example below this. Say example 2. Amount of last dividend paid. Example 2. Amount of last dividend paid 10 rupees. Required rate of return. Required rate of return 15%. Required rate of return 15%. A constant growth of dividend rate. A constant rate of growth in dividend. Constant rate of growth in dividend 5%. Have you written this? 5%. Then below write down value of the stock today can be calculated as. Oh, you've got 200. Okay. How much was the dividend? 10%. Right? So we will say 10 into 1.05 divided by 10%. It would be 105. Yes, how are we getting 105? We said 10 into 1 plus 5%, which is nothing but whatever is the dividend plus the growth. We are taking dividend of next period, dividend of time period 1 divided by KE minus G. Because if I want to value stock today, I will always take dividend of time 1, cash flow of time 1. Is this clear? Are we good to move? So now we are well equipped to solve this question. I will be happy if you can solve this now. We'll read this together one more time. The beta coefficient of Target Limited is 1.40. The company has been maintaining 8% rate of growth in the dividend and earnings. Last dividend was rupees 4 per share. Okay, so we have the growth rate, we have last dividend, we have beta, we have return on government security, we have return on market. Okay, so can we calculate required rate of return on this security with this data using CAPM? Yes, so required rate of return is nothing but your KE, cost of equity. Do we also have the growth rate? Yes, we have the growth rate. Let me increase the size, it's not so clear here. Yes, so we have the beta from which we can calculate required rate of return. We have the growth rate, we have the last dividend. Quickly calculate and tell me what should be the equilibrium price of share. Yes, what is the answer? आप दोनों का आ गया 48. About the ladies there. What is the required rate of return? 17%. All of you getting this? Yes, so what is the answer? Answer is simple. Current dividend is 4. Next dividend would be 4.32. And 4.32 divided by 17 minus 8, which is 9%. So the answer is simply 4.32 divided by 9%, which would be 48. Yes, are you done? Are you all of you getting 48? Anyone struggling here? Okay. And then how do you solve part 2? So for part 2 you can make a small table. Here you would say market value of the stock. Market value of the stock is given as 6. So market value is 36. Say intrinsic value of stock 48. Therefore outlook is stock is undervalued. And therefore recommended action buy. Why? Because the stock is worth 48 and intrinsic value is given as only, the market value is only 36, so we should buy. In case if you can't read what I've written, this is market value of stock 36, this is intrinsic value of stock 48, outlook stock is undervalued, recommended action buy. Are we good to move? Any question you want to ask here? Yes, Niranjan? Easy, difficult? Very easy, very difficult, completely out of league. समझ में आ रहा है नहीं आ रहा है? Good. So I don't know if you know, how many of you speak Marathi? Nandi will माहिती का? चलो, next question number 17 here. Capum investing decision. An investor is holding 1000 shares of flat glass company. Presently the dividend being paid by a company is 2 per share and the share is being sold at 25 per share in the market. However, several factors are likely to change during the course of the year indicated below. Existing 12% है, revised 10% होगा. Market risk premium will change. Beta value is going to change. Expected growth rate is going to change significantly. Now, in view of the above factors, whether investors should buy, hold or sell the shares, why? कैसे करेंगे एनालिसिस? करेक्ट. नहीं नहीं, अभी केस का सवाल ही नहीं है ना, बिकॉज ये रिवाइज्ड है. सो अभी हम लोग इस केस में ही है. आई फॉलोइंग व्हाट आई एम सेइंग? तो अभी हमारे पास चॉइस नहीं कि एग्जिस्टिंग केस होगा. केस इज गोइंग टू चेंज, बट देन वी विल स्टिल सॉल्व in both the formats because that's what ideally we don't really need to solve existing one because anyways it's gone now, so we should ideally be calculating only the revised one, but in your practice manual they solve for existing one as well. So we'll solve both to demonstrate that we know how to solve. So let's write down here. We will say, so you can give heading, say calculation of required rate of return and calculation of required rate of return and intrinsic value. Intrinsic value means justified value of the stock. Okay, this is your heading. Then let us start plotting the important data here. Existing revise. So we can say existing scenario. Revised scenario. RFR, risk-free rate. $12 and 10%. can say in, no, not required. Then next one, market risk premium. Market risk premium 6 and 4. Beta value 1.4, 1.25. Then say required rate of return. You'll say required rate of return. So expected return is equal to RFR plus market risk premium into beta. So is equal to 12 plus 6 into 1.5. Have you got the same values? See here, now in this example they've given us market risk premium directly, isn't it? So we don't have to reduce it from market. That means return on market must have been how much? In existing scenario, return on market was how much? 18%. And in the revised scenario, return on market was 14%. But they've just given us the premium directly, so we use it as it is. Then next one, say current dividend. Current dividend was 2 and 2. Then say dividend at time 1, okay, where D1 is equal to D0 into 1 plus growth rate. So is equal to 2 multiplied with 1 plus, oh, have we not plotted the growth rates? Wait a minute. So we need one more row here. Say expected, you can write it below that. Expected growth rates 5% and 9%. So is equal to 2 multiplied with 1 plus 5% and 1 plus 9%, 2.118. And then intrinsic value of stock using Gordon growth formula. Intrinsic value of the stock using Gordon growth formula. So here you will say value at time 0 is equal to dividend of time 1 divided by KE minus G. Okay, is equal to 2.1 divided by 20.4% minus 5% is equal to 2.18 divided by 15% minus 9%. Yes, are we done? Okay then, question number 18. CAPM, Portfolio Management, Portfolio Risk and Evaluation. XYZ Limited has substantial cash flows, and until the surplus funds are utilized to meet the future capital expenditure likely to happen after several months, are invested in a portfolio of short-term equity investments, detail for which are given below. So we have 4 investment, we have number of shares, we have betas, market price per share, expected dividend yield. The current market return is 19%, risk-free rate is 11%. Calculate the risk of XYZ's short-term investment portfolio relative to that of market. Whether XYZ should change the composition of its portfolio. Okay. So, tell me, how should we calculate this? Yes, how should we calculate? Who has to solve the paper? There would be no one to dictate on the exam. You'll have to think and solve. How should we approach this question? Correct. We have to calculate risk of the portfolio relative to market. So what is measure of risk? We saw that there can be 2 types of risk, either standard deviation or beta, isn't it? And when we say relative to market, of course they are referring to beta, which means that what the question number 1 is requiring us to calculate is the beta of the portfolio. How do you calculate beta of the portfolio? No, there is no formula. Don't look for it. It's common sense. Yes. We find the weighted average. That beta for portfolio is nothing but its weighted average, where we will say number of shares 60,000 into market price, correct? And then that would give us the market constitution, the weights of them. Then calculate weight of each of the security, and then multiply that with beta and calculate weighted average. That's it. Are we clear here? How do you solve for the second part? So fair enough. This was actually the easier part of this question. Whether XYZ should change the composition of its portfolio? How should we calculate for this? Okay, what I'll do is I'm mailing you this question today. For a few of you, I'll put this on WhatsApp. I want you to solve and come tomorrow. Think over the second part, that how are we going to solve the second part, that whether XYZ should change the composition of the portfolio, and then we will discuss tomorrow. Okay. But think over it. See, I think we are not really going in the right direction, because if I solve all the questions for you, it's not adding value, trust me. It's like reading a book. It's just that I'm kind of a speaking book for you as of now. Nothing else. But if you don't learn to think, there is no benefit of coming here and learning, because you'd forget very soon. The only way you'd remember it is you start thinking.